Welcome back to the deep dive. We are cutting through the noise today, looking at a sector maybe not always in the headlines, school bus manufacturing.
Right.
Specifically, we're really digging into the latest from Blue Bird. They just put up some massive results. Honestly, it looks less like just improvement and more like a real inflection point.
That's absolutely right. We're looking at the details from their fiscal 2025 third quarter earnings call that happened right after market close back on August 6th.
Oh, okay.
And the whole tone of that call, just deep confidence. You could feel it.
Yeah.
And well, the market reaction certainly reflected that. It really validated the strategic path they've been on.
So our mission today is pretty straightforward.
Okay.
Give you the quick breakdown. We'll hit the key financial wins, understand those strategic pivots they're making, especially around alternative fuels.
Yeah, that's crucial.
And look at the capital allocation, because those moves definitely drove a lot of that market optimism. Let's start right at the top, though. The numbers themselves were, well, kind of shocking.
They really were. I mean, the headline results just blew past what the street expected. Their non-GAAP adjusted EPS, it landed at $1.19.
$1.19. Okay, and what was consensus?
Consensus was sitting closer to 90 cents. So you're talking a huge beat there, roughly 32%.
Wow.
Yeah. That kind of outperformance, it doesn't just happen, right? It takes some serious execution.
And often, when you see an earnings beat that wide, maybe the revenue lags a bit sometimes.
Mm-hmm.
But that wasn't the case here at all.
I'm not even close. Revenue was $398 million.
$398.
Yeah, almost 20% year-over-year growth.
Yeah.
And it comfortably cleared even the high end of what analysts were forecasting. Management sounded, pretty happy about it. Kept talking about all-time quarterly records, both sales and adjusted EBITDA.
That's the qualitative side, the all-time record stamp. But what about core profitability? The metric investors really track, that adjusted EBITDA margin.
Right. So adjusted EBITDA hit $58.5 million.
Okay.
Which translates to a very, very healthy 14.7% margin for the quarter.
14.7%.
Yeah. And what's really interesting is that this margin strength, it doesn't feel like a fluke. Yeah. It looks like a direct result of operational changes they've been making, finally hitting the bottom line.
Okay, let's unpack those operations then. Because, records don't just happen by accident. They sold 2,467 buses in the quarter. Solid volume, sure, but the real story seems to be the product mix.
Absolutely. This is where Blue Bird really stands out. What gives them a competitive edge? A massive 61% of their Q3 unit mix was alternative power.
61%.
Primarily propane and gasoline tech. And this is critical because if you look at their big traditional competitors, they're typically seeing maybe, 10%, 15% mix in all power, tops.
Wait, hold on. 61 versus 15. Why is that gap so enormous? And I mean, beyond just the environmental angle, why should that matter to someone looking at the financials?
It matters hugely because of TCO, total cost of ownership. Propane, especially, offers really significant savings on fuel costs, reduced maintenance compared to diesel. Blue Bird basically pioneered this space. And that TCO advantage, it often locks school districts in for years. It creates really sticky demand, predictable volume, kind of regardless of where diesel prices go.
Makes sense. And their EV story, while maybe smaller volume-wise, it's clearly picking up steam.
It is, yeah. They delivered a record 271 EV units. That made up about 11% of their volume this quarter.
11% from EVs.
Now, the pipeline looks strong, too. They've got about 1,200 EV units either sold or in firm backlog right now.
Mm-hmm.
They're forecasting around 900 EV sales for the full fiscal year 25. So, yeah, they're executing across all the key powertrain shifts.
Okay, now let's pivot a bit. Macro headwinds. Tariffs, supply chain chaos. It's been rough for manufacturers, yet their average selling prices, ASPs, they were still up almost, $7,700 per bus, just quarter over quarter?
Yeah, pretty strong pricing.
How did they handle the new tariff environment? The EU, 15%, the China, 30% stuff. How did they manage that without crushing those margins they just built up?
Well, they confirmed they're using a pretty disciplined approach. A margin-neutral tariff strategy.
Margin-neutral, meaning
they're taking pricing actions?
Yeah.
Including passing through those tariff costs, basically, to offset the volatility.
Okay.
But the really key insight, I think, is what this means for their customers, the school districts.
Right. What's the impact there?
They've extended price certainty for these districts through the end of March next year. So think about it. While other manufacturers might be hitting districts with sudden price hikes because of tariffs, Blue Bird is offering stability, predictability. And if you're a public institution on a tight budget, that certainty is incredibly valuable.
That is crucial, especially since they did admit, right, that near-term order intake slowed down a bit because of all the uncertainty around tariff policies.
They did acknowledge that, yeah. But they really framed it as just a temporary delay. The underlying market drivers, still incredibly strong.
Like the aging fleet.
Exactly. You've got this huge aging national fleet that needs replacing. Plus, tons of pent-up demand from all the earlier supply chain issues. They see the market as structurally healthy. Orders will come back once things settle. And their backlog, still solid, right in that sweet spot, they called it, around 3 of 900 units. Gives them great visibility for the near term.
Okay, now this is where it gets really interesting for me. Strategy. So past margin gains came from lean manufacturing, right? Efficiency drives. How do they keep this going? How do they sustain this expansion, especially when they're targeting that high 15% margin number long term?
Right. So the next way, the future improvements. They're looking at significant new investments in modernization, things like automation, advanced manufacturing execution systems, MES.
Okay.
They're deep in planning that now as part of a long-term strategy review. And that includes leveraging the new plant they're building, the one partly funded by that DOE grant.
It really sounds like they're trying to bring, 21st century manufacturing tech into a company that's been around forever. What's the potential leverage there? Is it big?
Oh, the potential leverage is enormous.
Yeah.
You can see a path to operational gains that goes way beyond just raising prices.
Yeah.
If they can successfully automate some of the complex work, integrate systems better, cut waste, those productivity gains could compound year after year. That's how you hit those ambitious margin targets, even as you ramp up volume.
And speaking of ramping up and expanding, let's talk specifics. Microbird and this Class 5-6 chassis, these sound like jargon, maybe, but they seem like huge pivot points.
They really are.
What exactly is a Class 5-6 strip commercial chassis, and why does that suddenly put them into a totally different, much bigger market?
So that Class 5-6 chassis, think of it as the basic foundation, the frame and powertrain for medium-duty trucks.
Okay, like delivery trucks. Utility trucks.
Yeah, exactly. Package delivery, utility work, box trucks. Yeah. It's a market vastly larger than just school buses. By moving into this segment, especially using their advantage in alternative power like propane and gas.
Leveraging that again.
Right. They can target this whole new wave of demand for cleaner medium-duty fleet vehicles. They're basically taking the TCO success story from school buses and applying it to the wider commercial market. Production starts in 2026.
And the Microbird expansion, what's that play?
That's kind of related, targeting smaller buses and shuttles. The new Microbird plant up in Plattsburgh, it's now building vehicles specifically aimed at the Buy America U.S. shuttle bus market.
Buy America, right. That requires domestic content.
Exactly. So by expanding this capacity, they're directly capturing a slice of the market that's harder for others to reach. It nicely complements their main large bus business.
Got it. And all this operational strength, this strategic expansion, it flowed right into their guidance. They bumped up the fiscal 25 outlook pretty significantly.
They did, yeah. They tightened the revenue guidance to about $1.45 billion.
$1.45 billion.
Adjusted EBITDA raised to a higher, narrower range. $205 million to $215 million. Midpoint's $210 million. That reflects that strong 14.5% margin for the full year. And crucially, adjusted free cash flow also got a nice bump, raised to $90 million to $100 million.
And that free cash flow number, that flexibility, that enabled the move. That to me signaled the most confidence in where they're headed, the capital allocation.
Absolutely. Announcing a big new $100 million share repurchase authorization.
Over the next 2 years.
Right. And this isn't their first rodeo with buybacks. It builds on a program they already completed. For management to commit $100 million to buying back stock, especially after the shares have run up, that's a powerful signal. They clearly think there's still significant value left in the equity.
And they back that up with a very bullish long-term outlook, too, targeting even higher margins down the road.
That's right. Management's now looking at adjusted EBITDA margins of 15.5% to 16%, maybe even plus, once revenues hit that $1.8 billion to $2 billion level. And they specifically called out how they get there. The growing EV mix, that new commercial chassis hitting the market, and the extra volume from the Microbird expansion. It all adds up.
So let's bring it together. Why does all this matter now? Beyond the record quarter, talk about sustainability. How fragile is this success? Are they just riding these big government subsidy waves?
That's a fair question, right? And management addressed it. They basically asserted that their gross margins are roughly the same percentage across all the different powertrains.
Okay, so diesel, propane, EV, similar margin profile.
Pretty much the same, yeah. And that's really key for resilience. It means even if, say, the EPA clean school bus money slows down a bit, or the mix shifts slightly away from EV back to propane for whatever reason, their overall profitability should hold up pretty well because of those underlying operational efficiency gains they've locked in. They're kind of powertrain agnostic on margins now.
So this quarter was really the proof point. Showed they could navigate major headwinds like those tariffs we talked about while still executing on efficiency and basically justifying the premium valuation the market seems to be giving them now.
And don't forget, those tailwinds you mentioned, still very much active. You've still got strong state subsidies kicking in New York, California, Oregon, Illinois, big markets. The federal EPA program still has rounds 4 and 5 playing out. And like we said, that fundamental need to replace old buses. That provides a solid demand floor for years.
Okay, let's turn the corner. Time for a segment for the truly curious. And just a reminder, folks, this is purely for entertainment, analyzing the call details. It is not financial advice. Absolutely not.
Definitely not financial advice. But all right, given everything we just unpacked, my outrageous but plausible trade thesis centers on that new Class 5-6 propane commercial chassis, specifically going long based on its potential being massively underestimated right now.
Underestimated? Why? I mean, management only guided to, what, 100 units for fiscal 26? That sounds tiny, like a rounding error?
Exactly. That 100-unit forecast. That's the definition of a lowball number.
Right.
Think about the size of the medium-duty truck market compared to school buses. It's way, way bigger.
Okay.
And Bluebird's coming in first with a differentiated propane option here. They already said they're seeing strong interest from potential fleet customers. The TCO benefits are proven from the bus side. If that demand clicks, they could blow past that initial 100-unit guidance almost instantly, triple it, easily, I think.
Okay, so if the guidance is that low, what's the trade structure to play that potential upside?
Well, the strategy could be combining a solid long position in Bluebird itself with maybe some tactical short exposure on a competitor. Specifically, a pure play competitor focused only on old school diesel powertrains in that medium duty space.
Pair trade.
Kind of. The argument is that Bluebird's better TCO from alternative fuels, propane, and EV will let them grab market share much faster than people expect in medium-duty trucks starting in 26. They'll just take share from the legacy guys. That gap between the cautious 100-unit guide and the actual market opportunity, that's your potential upside.
A compelling thesis, definitely built on that operational runway we spent time on today. Okay, so let's just quickly recap the core highlights from this quarter.
Yeah, sure. We saw record revenue, record profit. They really showed genuine margin protection, handling those tariffs effectively.
Right.
They significantly raised the full year guidance and then backed it all up with that big $100 million buyback authorization. The message seems pretty clear. This is a company feeling very much in control of its own profitable growth story.
It makes me wonder, though, looking at the longer term vision, management's doing this big review of manufacturing, specifically to bring in next-gen automation, advanced systems. This isn't just tweaking things. This is potentially transformative. How much real multi-year margin expansion is actually unlocked if they pull this off? If they successfully apply truly modern manufacturing tech to this century-old American industrial company?
That really is the multi-billion-dollar question, isn't it? That's what defines the next, say, 3 to 5 years for their valuation story. Definitely something worth thinking about as you watch this space and how they stack up against competitors.
We'll leave you with that thought to chew on. Thanks so much for joining us for this deep dive today. As always, remember, this is purely for informational purposes and analysis. We are definitely not providing financial advice. We appreciate you tuning in.